Well, I won't comment on the three companies that you've named, but in general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that I'm not sure will be a great technique. I mean, it may be great if you inherit it. Paul Getty inherited the money at the bottom in 32. I mean, he didn't inherit it exactly. He talked his mother out of it, but it's true, actually.
Close enough.
Yeah, close enough, right? But he benefited enormously by having access to a lot of cash in the early 30s that he didn't have access to in the late 20s, and so you can get some accidents like that. But that's a lot to count on, and if you start with the Dow at X and you think it's too high, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. Is Phil Carre here? We got the world. Yeah, there's the hero of investing. Phil, would you stand up? Phil is 99. He wrote a book on investing in 1924. Phil has done awfully well by finding businesses he likes and sticking with them and not worrying too much about what they do day to day. There's going to be I think there's going to be an article in the Wall Street Journal about Phil on May 28th, and I advise you all to read it. And you'll probably learn a lot more with him by coming to this meeting. But it's that approach of buying businesses. I mean, let's just say there was no stock market, and the owner of the best business in whatever your hometown is came to you and said, "Look, my brother just died, and he owned 20% of the business, and I want somebody to go in with me to buy that 20%, and the price looks a little high, maybe, but this is what I think I can get for it. Do you want to buy in?" I think if you like the business and you like the person who's coming to you and the price sounds reasonable, and you really know the business, I think probably the thing to do is to take it and don't worry about how it's quoted. And it won't be quoted tomorrow or next week or next month. I think people's investment would be more intelligent if stocks were quoted about once a year, but it isn't going to happen that way. So, and if you happen to come into some added money at some time when something dramatic has happened, I mean, we did well back in 1964 because American Express ran into a crook. We did well in 1976 because Geico auditors didn't know what the loss reserve should have been the previous couple of years. So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them. Zone 2, please.
Mr. Buffett, Mr. Munger, I'm Tim Medley from Jackson, Mississippi. My question is an allocation of capital one. You've indicated that one thing you like in companies is a willingness on the part of management to repurchase its own shares. Right. I wonder if you would talk for a minute about your own frame of reference on repurchases when it appears that the current price of the stock is rich in relation to its intrinsic value. And some have said that with the right company, ongoing repurchases of stock should be made irrespective of the price. So would you speak for a moment as to how you think it pencils out when the current price of the stock is rich in relation to its intrinsic value?
Yeah, if you're repurchasing shares above a rationally calculated intrinsic value, you are harming your shareholders. Just as if you issue shares beneath that figure, you are harming your shareholders. That's a truism. Now, the tough part of that, of course, is coming up with the intrinsic value. And, for example, a good example might be Coca-Cola. I think a number of people might have thought Coca-Cola was repurchasing shares at a very high price because they'll look at book value or PE ratios. But there's a lot more to intrinsic value than book value and PE ratios. Anytime anybody gives you some simplified formula for figuring it out, forget it. You have to understand the business. The people who understood that business well, the management, have understood and been very forthright about saying so over the years, that by repurchasing their shares, they are adding to the value per share for remaining shareholders. And like I say, people who didn't understand Coca-Cola or who thought mechanistic methods of valuation should take precedence, really misjudged the value to the Coca-Cola company of those repurchases. So we favor, when you have a wonderful business, we favor using funds that are generated at that business to make the business even more wonderful, and we favor repurchasing shares if those shares are below intrinsic value. And I would say that if it's a really wonderful business, we probably come up with higher intrinsic values than most people do. We have great respect, Charlie and I think it's developed over the years. We have enormous respect for the power of a really outstanding business, and we recognize how scarce they are. And if a management wishes to further intensify our ownership by repurchasing shares, we applaud. We just went over 8% of the Coca-Cola company probably in the last 3 or so months by a very tiny fraction. But we had a second purchase one time. But our percentage interest in the Coca-Cola company has gone up significantly through their repurchases, and we are better off because they have bought those shares at what looked like, to some people, perhaps, high prices. And we thought they were wrong at the time, and I think now it's been indicated that or proven. So I urge you, if you're trying to decide on the wisdom of repurchases or of share issuances, that you don't think in terms of book value, you don't think in terms of specific PEs, you don't think in terms of any little model, but you think in terms of what would you really, pick businesses you can understand, and then think what you really would pay to be in those businesses. And that's what counts over time, is whether the repurchases are made at a discount from that figure. And I would say with the companies that we own shares in, our interest in Geico went from 33 or so percent to 50% over a 15-year or so period, simply through repurchases, and we benefited significantly. So did every other shareholder, I might add, that stayed with the company, and we benefited in no way disproportionate to them. But that was a very wise action on their part. And there, too, they were all usually buying that stock at least double book value, and you could compare it to other insurance stocks and say, well, that's too much to pay. But Geico wasn't an insurance company that was comparable to other insurance companies. It was a very different sort of business, and they were very wise, in my view, to be following that course of action. Charlie? No? Zone 8, please.
Yes, Mr. Buffett, good morning. My name is Ed Wolzak from New York. I'm a student and admirer of your investment philosophy. I have a question. In determining a company's intrinsic value, you seem to write or indicate that you project out a company's owner earnings for a number of years and then discount that back by prevailing rates. My question is, how much of a premium, if any, to prevailing risk-free rates do you demand when you discount back the owner earnings of a company? Or stated differently, for example, today with long rates at about 7%, if you did the same exercise with Coca-Cola, at what rate of interest would you discount back their owner earnings?
Yeah, we get asked that question a lot, and we've answered it to some extent in past annual reports about what discount rate to use. We basically think in terms of the long-term government rate, and there may be times when in a very, because we don't think we're any good at predicting interest rates, but probably in times of what would seem like very low rates, we might use a little higher rate. But we don't put the risk factor in per se, because essentially the purity of the idea is that you're discounting future cash, and it doesn't make any difference whether cash comes from a risky business or a safe business, so-called safe business. So the value of the cash delivered by a water company, which is going to be around for 100 years, is not different than the value of the cash derived from some high-tech company, if any, that you might be looking at. It may be harder for you to make the estimate, and you may therefore want a bigger discount when you get all through with the calculation. But up to the point where you decide what you're willing to pay, you may decide you can't estimate it at all. I mean, that's what happens with us, with most companies. But we believe in using a government bond type interest rate. We believe in trying to stick with businesses where we think we can see the future reasonably well. You never see it perfectly, obviously, but where we think we have a reasonable handle on it. And we would differentiate to some extent. We don't want to go below a certain threshold of understanding, so we want to stick with businesses we understand quite well and not try to have the whole panoply with all different kinds of risk rates, because frankly we think that'd just be playing games with numbers. I mean, I don't think you can stick numbers on a highly speculative business where the whole industry is going to change in 5 years and have them mean anything when you get through. If you say I'm going to stick an extra 6% in on the interest rate to allow for the fact, I tend to think that's kind of nonsense. I mean, it may look mathematical, but it's mathematical gibberish in my view. You better just stick with businesses that you can understand, use the government bond rate, and when you can buy them something you understand well at a significant discount, then you should start getting excited. Charlie?
Yeah, the discounts were once greater than we now see.
That's all you're going to get, folks.